Markets don't fear bad news. They fear what most people haven't noticed yet. Most people believe markets move because of headlines. A crisis breaks, a number spikes, panic follows, and then prices react. But that's not how markets usually work. In reality, by the time bad news becomes obvious, markets have often already adjusted. Prices don't wait for confirmation. They respond to changes in structure, incentives, and rules, long before the story reaches the public. That's why some of the most violent price moves don't happen during disasters. They happen after, when people finally realize what quietly changed underneath. Silver's recent behavior fits this pattern. Sharp moves up, fast pullbacks, prices behaving differently depending on where and when trading happens. To many investors, this looks like chaos. But experienced market participants know something else may be happening. Volatility often signals a transition, not a breakdown. When rules evolve, when liquidity shifts, when certain behaviors are no longer tolerated, markets don't announce it loudly. They show it subtly, through pricing inconsistencies, sudden enforcement, and unexpected stress points. This isn't about fear, it's about awareness. Because markets rarely punish people for being wrong. They punish people for being late to notice what changed. Over the past year, the silver market has experienced unusually large price swings, with sharp upward moves followed by meaningful pullbacks. These movements have occurred over relatively short time frames, indicating elevated short-term volatility compared with recent years. At the same time, broader macro conditions have shifted. Measures of global uncertainty have risen steadily and recently reached their highest recorded levels, exceeding those observed during earlier global stress events. This increase has coincided with greater volatility across commodities, currencies, and interest rate markets. In silver specifically, price divergence across regions has become more visible. Physical and futures-linked silver prices in China have traded at a persistent premium relative to U.S.-based benchmarks, including the COMEX reference price. This premium has remained even during periods when U.S. silver prices corrected lower, indicating region-specific supply, demand, or market structure factors rather than a purely global repricing. On the regulatory side, Chinese exchanges have taken recent enforcement actions. The Shanghai Futures Exchange has suspended multiple groups of trading accounts over a short period, citing trading violations. These actions followed earlier notices emphasizing stricter compliance and monitoring in metals trading. In addition, Chinese authorities announced changes affecting silver delivery allocations for certain market participants, with new rules scheduled to take effect in early 2026. These changes specifically apply to participants without designated hedging quotas and alter how delivery access is assigned within the exchange framework. Historical data on silver pricing also highlights an unusual pattern. When long-term price performance is segmented by trading hours, returns differ materially between U.S. market hours and non-U.S. or overnight trading sessions. This divergence has widened over time and has become more visible as global trading volumes have shifted across regions. Compared with conditions 1 month ago, silver prices are lower in nominal terms, but volatility, regional price gaps, and regulatory activity are all higher. Compared with 1 year ago, uncertainty measures are higher, enforcement actions are more frequent, and attention to physical delivery mechanisms has increased. These are the observable facts. They describe what has changed without implying why it must continue or how prices will ultimately respond. What matters here is not a single price move, but the sequence of reactions now unfolding across the silver market. The first-order effect is straightforward. Higher uncertainty and tighter enforcement coincide with increased price volatility. When uncertainty rises, liquidity providers widen spreads, leverage becomes more expensive, and short-term positioning turns more defensive. This alone can amplify price swings without any change in long-term fundamentals. The second-order effects are more structural. Recent enforcement actions and announced rule changes alter who can participate, how positions are carried, and how delivery risk is managed. When trading rules become more restrictive, particularly around leverage and settlement, participants who relied on short-term or highly leveraged strategies are forced to reduce exposure. This can reduce paper liquidity even if physical supply remains unchanged. At the same time, delivery-related adjustments shift incentives. When access to delivery becomes more conditional, market participants place greater emphasis on where silver is held, under what jurisdiction, and under which settlement rules. This helps explain why regional price differences can persist rather than arbitrage away quickly. Another important chain reaction involves risk transfer. When exchanges increase enforcement or tighten allocation rules, risk does not disappear, it is redistributed. Some risk moves from exchanges to private balance sheets. Some moves from leveraged traders to end users. Some shifts geographically. These transitions often occur quietly and are only visible through changes in volatility, open interest, and regional pricing. The impact is not uniform across participants. Short-term traders are affected first, as tighter rules and higher volatility increase margin and execution risk. Industrial users are affected later, particularly if procurement planning depends on predictable delivery terms. Longer-term holders are affected last, primarily through changes in liquidity conditions rather than immediate price direction. Importantly, none of these effects require a shortage narrative to function. Markets can experience significant stress simply from rule changes and enforcement consistency, even when aggregate supply and demand remain broadly balanced. There is also a signaling effect. When authorities prioritize delivery integrity, leverage discipline, and compliance, markets interpret this as a shift toward risk containment rather than price support. That interpretation alone can change behavior, independent of the actual text of the rules. Finally, these developments interact with global uncertainty. In periods of low uncertainty, rule changes are absorbed gradually. In periods of high uncertainty, the same changes can have outsized effects because participants are already cautious and less willing to provide liquidity. This is why the current environment matters beyond today's price. It reflects how the system is adjusting, not just how silver is trading. Periods like the current one often feel unprecedented, but markets have experienced comparable combinations of volatility, rule changes, and uncertainty before. The value of history is not in predicting outcomes, but in filtering emotional reactions and clarifying what truly matters. One comparable environment occurred during the late 1970s. At that time, silver prices were volatile, macro uncertainty was elevated, and monetary regimes were shifting. What mattered most then was not the final price peak, but the run-up phase where liquidity tightened and price discovery became increasingly uneven across markets. Before prices reached their extremes, trading behavior changed first. Spreads widened, leverage became unstable, and delivery risk gained importance. Another relevant period was the early 2000s. Following the global financial crisis, precious metals experienced renewed interest amid unconventional monetary policy. Silver prices moved sharply, but the key dynamic again preceded the headline outcome. Volatility rose first. Regulatory scrutiny increased next. Then participation narrowed as some strategies became less viable under new constraints. Price followed these structural adjustments, not the other way around. In both cases, the most important signals were not the peaks or collapses, but the transitions beforehand. Rising volatility before fundamentals visibly changed. Increasing divergence between paper pricing and physical considerations. Shifts in who provided liquidity and under what conditions. However, there are also important differences today. Unlike earlier periods, the current environment is more globally fragmented. Trading, settlement, and regulatory enforcement are increasingly regional rather than uniform. This means price signals can persist in one market even when another market moves differently. Arbitrage still exists, but it is slower and more constrained by jurisdictional rules. Another difference is the role of policy visibility. In earlier cycles, many regulatory changes were reactive and implemented after market stress had already materialized. Today, enforcement actions and rule adjustments are often communicated in advance, which changes how participants position themselves. Markets respond not only to actions taken, but to expectations of enforcement consistency. Finally, the broader macro backdrop differs. Previous periods of silver volatility occurred alongside either inflation shocks or financial system repair. The current environment includes elevated uncertainty without a single dominant crisis, making market responses more dispersed and less linear. History suggests that when conditions look similar but not the same, emotional extrapolation becomes costly. The past shows that structure changes first, behavior adjusts second, and prices move last. This perspective does not tell us what will happen next. It helps us understand what kind of environment we are actually in. Professional analysis does not attempt to predict a single outcome. Instead, it maps multiple plausible paths, assigns conditional logic to each, and remains flexible as new information emerges. Below are three structured scenarios based on current conditions, using if/then reasoning rather than certainty. Bull case, volatility resolves into sustained strength. If elevated global uncertainty persists while regulatory enforcement continues to emphasize delivery discipline and leverage control, then silver prices could remain supported over time, even if short-term volatility stays high. In this scenario, the key driver is not speculative demand, but structural demand for risk-managed exposure. Reduced tolerance for highly leveraged positions may lower paper liquidity, making prices more sensitive to incremental demand. Regional pricing differences could persist if physical access, settlement rules, or inventory availability remain uneven across jurisdictions. Strength would likely be uneven and nonlinear, characterized by sharp advances followed by shallow pullbacks rather than smooth trends. Importantly, this outcome would depend on continued enforcement consistency and stable macro conditions rather than a sudden surge in investor enthusiasm. This scenario does not require supply shock. It requires constrained liquidity combined with steady participation. Base case, range-bound prices with elevated volatility. If uncertainty stabilizes and markets adapt to recent rule changes without further escalation, then silver prices may enter a prolonged consolidation phase. In this case, volatility remains above historical averages, but directional momentum fades. Participants adjust strategies, liquidity gradually returns, and regional price differences narrow, but do not fully disappear. Physical and paper markets coexist with greater awareness of settlement risk, but without triggering aggressive repositioning. This scenario reflects a market digesting structural change rather than reacting to it. Price movements would likely respond more closely to macro inputs, such as interest rates, currency fluctuations, and industrial demand signals. For many participants, this environment favors patience and selectivity rather than aggressive positioning. The market continues to function, but without a clear directional narrative dominating behavior. Bear case, structural concerns ease, pressure reasserts. If enforcement actions slow, delivery rules are softened, or broader uncertainty declines meaningfully, then recent volatility could unwind to the downside. In this scenario, risk premiums embedded in silver prices compress. Liquidity improves, leverage returns, and short-term traders regain confidence. Regional price gaps narrow rapidly as arbitrage becomes easier and less constrained. This outcome would not imply failure of the market structure. Instead, it would suggest that recent adjustments were absorbed without lasting impact, allowing previous trading dynamics to reassert themselves. Prices could retrace a portion of earlier gains, particularly if real yields rise or the US dollar strengthens concurrently. Volatility would likely decline alongside price, signaling normalization rather than distress. Scenario discipline. None of these scenarios are forecasts. They are decision frameworks. The market will not announce which path it chooses in advance. It will reveal it gradually through behavior, liquidity, and response to new information. The goal is not to be right, it is to be prepared. Rather than reacting to headlines or short-term price moves, I focus on a small set of indicators that help clarify whether conditions are tightening, stabilizing, or easing. These inputs matter because they reflect how capital, liquidity, and risk appetite are actually behaving beneath the surface. First, I monitor the US dollar index, DXY. Silver has historically shown sensitivity to dollar strength, not because of sentiment, but because the dollar affects global purchasing power and cross-border flows. A persistently stronger dollar tends to pressure metals prices, while periods of dollar consolidation or decline often reduce that headwind. I am less interested in daily moves and more focused on whether the trend is accelerating or losing momentum. Second, I watch U.S. Treasury yields, particularly real yields. Changes in real yields influence the opportunity cost of holding non-yielding assets like silver. Rising real yields tend to attract capital toward fixed income, while stable or declining real yields can reduce that competition. What matters most is the direction and speed of change, not the absolute level. Third, inflation data such as CPI and PCE provide context rather than signals. These reports influence expectations around monetary policy, which in turn affects liquidity conditions. I pay attention to whether inflation surprises are becoming more frequent and whether markets react strongly or absorb the data calmly. The reaction often matters more than the number itself. Fourth, I track volume, liquidity, and open interest in silver markets. Rising volatility accompanied by falling open interest can indicate forced position reductions rather than new conviction. Conversely, rising open interest alongside stable liquidity suggests broader participation. These dynamics help distinguish structural adjustment from speculative momentum. Finally, I observe regional price behavior and settlement conditions. Persistent price differences across markets, changes in delivery terms, or shifts in inventory reporting often signal stress points before they appear in headline prices. Individually, none of these indicators provide certainty. Together, they form a framework for understanding how the market is functioning, not just where price happens to be today. At times like this, it's easy to feel pressure to act quickly. Volatility draws attention and uncertainty creates noise. But markets rarely reward urgency without preparation. What we're seeing in silver is not a single story or a guaranteed outcome. It's a market adjusting to higher uncertainty, evolving rules, and shifting participation. Those adjustments take time, and they rarely move in straight lines. For long-term investors and disciplined traders alike, the priority is not predicting the next price move. It's managing risk, maintaining flexibility, and staying focused on what actually changes market behavior. That means watching liquidity, policy signals, and macro conditions, not reacting to every headline or chart pattern. Periods like this tend to favor patience over prediction and process over conviction. Markets will eventually clarify which path they're taking. Until then, the most valuable position is often a well-informed one. This isn't investment advice. It's simply how I'm reading the market right now.